then Ramez can get on. Hey everybody, it's Mick Lebinskas from Climate Salad. We've got a great workshop session here with Ramez, who's joining us from Seattle. You can see in the background that Ramez has got the sun setting behind him on some wind farms and solar panels. Looks like another lovely day there in Seattle. I will do a welcome to country, acknowledge the Indigenous original owners of this land. I'm coming from the Camaragal land here in Lane Cove, and acknowledge our Indigenous leaders past and present and emerging. And really looking forward to this chat. Ramez and I met in San Francisco a few years ago through a few connections, and stayed in touch with me coming back to Australia. He's a major powerhouse in terms of both, I think, influence in terms of this space as it's converted from clean tech into climate tech, and has a lot of really passionate views on what we can be doing to have more impact. While we're waiting for one or two more guests, since we're founder focused, Tim, can you give us the 30-second pitch on Energy Bank?
Awesome. Yeah, so I'm CEO and co-founder of a company called Energy Bank, and we're developing a novel energy storage technology called DOGES. It's acronym, so Deep Ocean Gravitational Energy Storage, so trying to leverage the depths of the ocean to store lots of energy en masse. And yeah, we basically have a grand vision of building city-scale batteries using that. Getting there, we're kind of maturing how we get there at the moment. And yeah, in terms of stages, we've just hired 6 people, so that's going to make things exciting for the next 18 months.
Yeah. Big ambition, big challenge. So thank you, Tim. We have Ankit from Facade. So can you give us a quick 28-second pitch?
Cheers, Mick. Hi, everyone. I'm Ankit from Facade, and what we've done is we've built a platform that lets you connect all your cloud services into one portal and identify what you're using, what you're doing with it, and the impact. The internet is the fastest growing sector in the world, and we're creating more data, more services, more than ever, and that has an ultimate impact in the infrastructure that's needed, but we're trying to solve the problem on the end user level and empowering people to take control of their own data.
And Kate, as I've said, if you can find a way to dedupe my photos that I've got in 14 different cloud locations and overpaying for, but I just can't get rid of those because I'm destroying my old photos. But we've also got Bill from Enosi. He's our last other founder on the call. Bill, you got 30 seconds for a quick pitch on Enosi?
Thanks, Mick. I wasn't expecting that.
No. Always be pitching.
Always be pitching. Fair enough. No, Enosi, best way to describe is a platform for, let's call it tracing your energy at the time. So source to socket. Peer-to-peer trading is one aspect of it, but dealing directly with wind farms and solar farms and talking to various corporates and enterprise customers about doing various energy plans and how they can be on a path to what we call true zero, 24/7 carbon-free energy, which is the new UN compact. So yeah, there we go.
Excellent. And Ramez, we've got about 100 companies in our community. They're obviously all out getting more customers, but we've got a nice healthy range across ag, energy, materials, software, hardware, etc. And looking forward to hearing some of your content, and we'll open up for some Q&A after that. So without further ado, I'll pass it over to Ramez.
Fantastic. Thanks, Mick. I'll share my slides now. I've got a lot of slides. I'm going to skip probably about half of them in the course of this, since we're a small group and we'll have lots of time for discussion, hopefully. So you know who I am a software guy by training. I spent 13 years at Microsoft, ran a tech startup, and then I spent the last decade or 11 years at a place called Singularity University, where we look at the use of exponential technology, things like AI software, but also energy, 3D printing, and so on, to address global grand challenges, how to help billions of people around the world. And so I sort of accidentally came in from being a software person to being interested in climate, writing a book, just fascinated by the power of innovation to address climate change. What I saw is exponential cost decline in things like solar and batteries, I'll talk about in a bit. And That led to me being a clean tech investor myself. So in clean tech investing since about 2014, I have about 40 companies in my portfolio. Have my first real exit happen last month. I'll talk about that a little bit. It's definitely a long time to be in a cost center before being in the black. And now just in September, I joined a deep tech venture fund. So I'm the chief futurist at a $1 billion AUM fund called Prime Movers Lab, which the motto is investing in breakthrough science startups to realize billions. About 40% of our portfolio is climate. So probably that's all I'll say about that, but I'm happy to answer questions about that. So I came into climate change really because of the impact. But when I talk a lot to corporate audiences and investors, you know, whether it's private equity funds or sovereign wealth funds or large energy companies, and talk about this concept that there is $100 trillion in capital turnover in the clean energy revolution between now and 2050. That's a ballpark. You see estimates all over. I didn't just make this number up. Bloomberg Energy Finance estimates that to get to net zero by 2050 is only 87 billion and 87 trillion, not billion, and 180 trillion in new capex. You see other estimates sort of around that ballpark. UPS is the one that first said 100 trillion. So this is one of the great investment opportunities ever in the last century. And at the same time, we're doing it out of necessity, or at least we're getting it started out of necessity, because as you all know, climate change is a very real phenomenon that's happened. We've been talking about it for 30, 40 years, really since 1896, Svante Arrhenius, that first said that CO2 in concentrations in the atmosphere would lead to a warmer planet. He was a Swede. He thought that was a great thing. Sweden would finally be a livable place. Most of the rest of us are finding it not such a great thing overall. And I don't have to tell you, while climate change is a somewhat stochastic phenomenon, at least weather is, numbers go up and down of temperature. Overall, if you zoom out, temperature keeps rising and rising and rising. And I think a sea change, this is important from a standpoint of investment, that's happened over the last few years is that despite this clear trend of temperatures rising over the course of years and decades, most people still thought of the impacts of climate change as being decades in the future. And that has changed. The last 3 or 4 years have really changed that, with the fires in Australia that happened over the last 24, 36 months, really last year, last summer, being a horrific experience. At fires in California, the heat wave, I don't know if you follow this, over the US Pacific Northwest. I live in Seattle, Washington. 108 degrees F is not normal by any means. Lytton, Canada, British Columbia there, a town recorded Canada's all-time high temperature, and then promptly 2 days later, the entire town burnt to the ground. So there is a phenomena of the world suddenly waking up because of these stochastic events, where we know that climate change makes them more likely, but we couldn't predict exactly what year they would happen. Suddenly people who used to think climate change was a phenomenon that their kids would experience the impacts of, or their grandkids would experience the impacts of, now feeling that this is a phenomenon that they are experiencing right now. And probably most significantly, that's being felt in Silicon Valley and in the Bay Area because of the ability there to leverage gigantic amounts of venture capital and huge amounts of new venture capital moving into this sector in just the last 12 months, but also happening in some other important places. It's happening in Europe. This is Germany this past summer. So that's July of 2021, so winter for you. Unprecedented flooding in Germany and Austria. And then in China, the #1 energy consumer around the world, also the #1 market for clean tech around the world. Unprecedented flooding happening in the interior of China. So all of that is a bad thing, obviously, and yet it's also something that has moved the perception of climate impacts from something that is distantly in the future, something that is now. And as a result of this, and I have a slide on this, but just to be straightforward about this, as a result of this, there has never been a time in history where there's been more climate finance available, either from a venture standpoint, probably somewhere between 10, 15, 20 billion US dollars in new venture funds around climate in the last 12 months being formed, and a lot of venture veterans who came out of non-climate areas forming, and also about $500 billion a year now in project finance happening for climate, maybe heading to $1 trillion a year around 2030. So there's a lot of despair, I would say, and it's legitimate to be extremely concerned. But there's also this phenomenon that these climate-linked events, these events that climate makes more likely, plus long-term policy decisions in various parts of the world, are making it such that there are more capital flows into climate tech today than ever before, which makes it actually the best time to be a climate founder than ever before. And now I want to say, I talk to a lot of business audiences. And so I just talk about the inevitability of clean energy, clean tech, climate tech being cheaper than dirty technology. But let's be honest, like the way that this works and has worked over the last 30 odd years is there's a feedback loop. And the feedback loop was really initiated by policy. It was initiated by nations primarily in Europe, pushing policy to clean up their economies, to clean up their energy supply, their electricity supply, first and foremost. That created an incentive to deploy technology. That made the technology cheaper. That made it more appealing to consumers and businesses, and also made policy aspirations rise. And that's the feedback loop. A reporter for The Atlantic called this recently the green whirlpool, or the green vortex. This is just what Amazon would call a flywheel, or what I call a positive feedback loop. And this is what gives me the greatest hope around climate overall. And where it started, most of you already know this is a map of how much sunlight, the solar potential of different countries around the world is. And we all know where solar got its start, right? Anybody want to say out loud, where did solar really get going first and foremost? Just unmute yourself and say it. Mick, sorry.
Was it the space program?
Oh, that's actually a good analysis. In a way, it did. It got started for a very expensive application where there was no other alternative in the space.
Not sure on Earth. Someone else might go. Mike Nichols probably knows, but
Germany, that's exactly right. And you see Germany is in the upper center of this map. And Germany, green is not good on this map. Green means low solar irradiation over the course of the year. And there's few, most of Canada gets more sunlight than Germany. But the Germans started this political push on deploying solar, and that led to what we've seen in solar cost reduction. I'll talk about the mechanism of that in a moment. The energy window, as we say. The Danes really started it in Denmark with wind, the Norwegians with electric vehicles, though EVs perform the worst in very cold climates. But that led to this incredible cost decline that we've seen in clean energy, the solar and wind, but also happening in batteries and grid, stationary storage, and electric vehicles, and a variety of other places. This is an amazing thing for the world. It's also a scary thing for both investors and founders. I'll talk a little bit more about that. So just to go really fast, if you build a new coal or gas plant around the world, it'll cost you per kilowatt hour somewhere in the range of 5 to 10 cents per kilowatt hour you produce over the lifetime of that plant. And so when the Germans or the Danes started their clean energy programs, 1980, electricity from wind cost 10 times what electricity from coal did. but it is plunged in cost. And that plunge in cost is not an accident, and it's not limited to one country. That was US data. It's happening in parts of South Asia. It's happening in parts of Latin America. It's happening in Australia, though we have a harder time getting really crisp data from Australia since the utility model that you have doesn't lead to open auctions overall, but it's happened around the world. We've moved from a first phase of wind power where it was entirely policy dependent to a second phase where it's competitive for new power, cost competitive, that red dashed line being sort of an average cost for fossil electricity around the world. And the reason that's happened, and the most important tool for economic analysis of the cost of new technologies, and I try to hammer this home wherever I go, is what we call Wright's law. You've probably all heard of Moore's law. Moore's law is the doubling of price performance of computing per 18 months. It's not where it started out, but that's how we think of it now. Moore's law isn't special. Moore's law is just one case of something called Wright's law. This is actually a much more fundamental thing in technology, which is that in mass-produced and modular technologies, where you make it in a factory and you make it repeatedly, lots and lots and lots of production of the same part, you get this phenomenon called technological learning, where every doubling of cumulative scale brings down the cost by some percentage. And the percentage, the rate, the slope of the learning curve graph, if you will, varies from technology to technology. The more modular and single piece of technology is, the faster it is. Multi-part complex technologies go slower. So solar goes faster than wind, for instance. But this goes back, this is found during World War II in aircraft, but it goes back to the Ford Model T, where if you go back in history and you study this classic paper from the Santa Fe Institute found that every doubling of Ford Model T cumulative production brought down the cost by about 15%. This is a log scale. The y-axis is exponential number of units or exponential cost. The x-axis is exponential number of units, and you see this straight line, more or less, technological learning. Now we see that in wind power. Of course, the real world isn't the same as a graph on paper, so it actually varies. But in wind power, it's been about 20% per doubling. Now I'm gonna go on to talk about other tech. Let me just say, this is one of the things that is most important to understand if you're a clean tech entrepreneur or a clean tech investor. Because we'll go back to Clean Tech 1.0, the investments made in 2005, 2006, 2007 that led to a huge bust around 2011 and so on. The main reason for that was this graph, not for wind specifically. People invested in thin film solar, people invested in biofuels, and they didn't understand that the dominant technologies, let's say silicon PV, would plunge in cost at the rate that they expected, or the rate that actually happened as they scaled. And so a host of new hard tech, deep tech investments in biofuels and solar were just squeezed out, because before they could get scaled, the dominant technology, as it doubled and doubled and doubled in scale, dropped in price. And even if the new technology was actually going to be cheaper, it just got squeezed out by the scaling of the dominant technology, or the existing status quo technology that got cheaper as a function of scale. This is a very wonderful phenomenon for consumers and for the world. It's a very scary phenomenon, and we have to understand as investors and entrepreneurs. So that basically means any new technology is going to be super expensive, most likely. But if you can get an initial toehold in new markets, that leads to more scale, prices fall. And if those prices fall, they lead to new markets, which lead to new scaling, which leads to new prices coming down. But that phenomenon can be exploited by an existing technology and not just a new technology. So it's important to understand that. Now, wind power on land has dropped in cost tremendously, but the fastest winds on Earth aren't on land, they're offshore. And offshore wind power, we used to think was never going to be cost competitive because you have saltwater issues, you have to have big jackup ships that put these things out there, you have to have these giant monopoles that anchor to the seabed, that actually support them on the seabed. Nevertheless, the cost of offshore wind has been plunging as well, dropped by about a factor of 4 in the last decade. And then beyond traditional offshore, for areas that have seabeds that get too deep too fast, like let's say Japan, or a lot of the coast of Asia, or the US West Coast, floating offshore is the next technology coming in that area. So I like to talk about wind a bit because people love solar, but wind is going to be a major component of the electricity system going forward because it's countercyclical. It produces at night, it produces in winter, and so on. This is what a floating wind foundation looks like. A lot of it's coming out of offshore oil exploration technology. But solar power is where we're seeing this tremendous, even faster cost decline from $100 per watt of power in 1975 for a solar panel to about 20 cents in 2020. It's up a bit. The supply chain changes in 2021, but that's a 500 times cost decline, almost nothing like it in physical infrastructure. And that means now we're seeing these incredibly low prices. The slide cited at 8, China now we're at 4.9 cents a kilowatt hour, cheaper than coal or gas. We're going through in 2020, 2021, the largest ever expansion of solar power ever in history, a lot of it fueled by unsubsidized projects in China, because at 4.9 cents, solar just makes a ton of sense, even without state level subsidies. And more importantly than that static price, it's that the cost has dropped by a factor of 6, actually, over the last decade. It won't drop that fast in the next 10 years. Maybe it'll drop by a factor of 2. Nevertheless, that is an enormous and important piece. India, now we're at well below the cost of coal. The US, in the Western US, we're below the cost of coal, but a 6x also declined in the last decade. And in various parts of the world, we're down to prices that are below the fuel cost of fuel going into already built coal and gas power plants. So solar dropping through these phases in the same way as wind, and solar has a faster learning rate. Solar drops about 30, maybe 35% per doubling. And solar is smaller than wind. So it's going to have more doublings, and each time it's going to drop in price more. Now, if you have solar and wind in a big grid, you can actually do a lot. In North America, for instance, with a national size grid and solar and wind, you can meet about 70% of US electricity demand just through those technologies. But ultimately, we're going to want to tackle this, and we are. Energy storage is now the most exciting space in clean energy. The lithium-ion batteries are dropping in price at a pace similar to or even faster than solar panels, about a 10 times cost reduction in the last decade. And there's dozens of other energy storage technologies. And one thing to be aware of is that, I'm sure most of you know this, the official forecasters in these spaces are extremely deceived. So the IEA, for instance, the International Energy Agency, puts out annual forecasts in their World Energy Outlook, what's going to happen with solar, among many, many other things, EVs, batteries, and every year they do this. They put out something like the colored line that says, here's the future rate of annual installations of solar. It's going to stay the same as it is today. Great, we've hit amazing new milestones. The black line is what actually happens. So on average, we've had more than a 30% CAGR in annual installations of solar around the world, where the official forecasters have put out these forecasts for basically 0 CAGR of new installations, or very, very low. 2020 being the first time the IEA has really seen substantial growth in their forecasts. And that's happening because they don't expect the pace of cost decline. Here's what the IEA thought costs of solar would look like in 2010 out to 2050. They projected $120 a megawatt hour, 12 cents a kilowatt hour would be the cost of solar by 2050. I have shown you deals at less than 2 cents. So here's what actually happened with the cost of solar. And so the cost of solar is a century ahead of what the world's leading energy forecasters said it would be. And if solar continues to decline in costs like this, by the time solar is about a third of global electricity, it'll be down to 1 US penny a kilowatt hour, half a penny a kilowatt hour in places like Australia. And that will just make it, well, not the solution to everything, not a panacea, doesn't produce at night, doesn't produce as much in winter, the unbeatable cost producer of electricity. Similar things in energy storage, where official forecast energy storage costs have been blown away by actual paces, and we have learning rates in energy storage that far outstrip what's actually expected. And new technologies in storage going beyond lithium ion batteries. This is an iron sodium flow battery. This is my first real exit. I invested in these guys in 2015 and in 2019, down to about 20 bucks a megawatt hour for 12 to 16 hour storage, and now valued at about $2.4 billion on the market. So happy about that. And of course, a lot of work in increasing energy density of batteries as well. Batteries are still much less energy per gram or per kilogram of mass, but a lot of people working on solid state batteries. Companies like QuantumScape, now worth $8 billion or more, Solid Power, SES, a whole variety of these. Probably they'll achieve about actually like a 60, 70, 80, maybe 100% boost in energy density of batteries, but that's very substantial as far as range of EVs go, and it will probably be accompanied by a reduction in cost as they reduce the cost of raw materials going into these. So clean energy is going to keep getting cheaper, and it's going to be cheaper, in fact, to produce electricity from clean sources than to keep existing fossil fuel assets running. I just want to move a little bit faster. So similar things are going to happen in transportation and in oil. Maybe you've heard this quote. This is Sheikh Ahmed Yamani. He was the Saudi oil minister during the 70s OPEC crisis. And in 2000, he said this. He said, the Stone Age didn't end for a lack of stone. And the oil age would run out before we ran out of oil. What he's saying here is that the Stone Age ended because of new technology called bronze. We invented a new technology, metallurgy, that allowed us to make things that were lighter, sharper, stronger, repairable, could fit new shapes and so on than stone did. And stone suddenly dropped in value, wasn't that important. And Yamani's saying, he was ahead of his time in 2000, saying that the same thing would happen in transportation and in fueling transportation. And he was well ahead of his time, but it's clear now that this is happening. And for most ground transport, for cars, trucks, buses, it is now the case that electrification is inevitable. I don't say that lightly. It's no longer a case of if or will electric drivetrains win. It's a question of how fast will they win. And the reason is very similar to the reason in electricity, which is electric vehicles will simply be cheaper than combustion engine vehicles. Just like that happened in electricity and solar and wind, we're going to see something similar happen in transport, because this is the entire engine and drivetrain of an electric vehicle. And this is the engine and drivetrain of a gasoline or diesel vehicle. So when you look at that, obviously the manufacturing cost of this, the assembly cost, is much, much lower. In fact, Ford says it takes half the factory floor space, half the factory capital cost a third less labor to make EVs. And the only things holding back EV costs have been that EVs are made at small scale and that batteries are expensive. But batteries, of course, are dropping in cost and EV scale is rising. So sometime in the next 3 to 5 years, we're going to hit the point where the walk-away price, the just store purchase price of an electric vehicle with, say, a 400-kilometer range is going to be cheaper than that of a similar gasoline vehicle. And that's going to lead to a tipping point in EV sales. EV sales already surging, 70% growth in 2021, 65% growth in 2020, even as the internal combustion engine vehicle market was in decline. And of course, as simpler vehicles with high efficiency electric motors with regenerative braking, these vehicles cost a lot less to maintain and fuel as well. So we're headed for a point where these vehicles may cost half as much per kilometer driven as gasoline or petrol vehicles. Commercial fleets realize that. Rivian IPOing and now at nearly $100 billion in valuation. Amazon put $1.3 billion into this company, in part under consumer pressure, in part under their employee pressure, but in part because they just saw this as a lower cost option for moving their goods. Similar things will happen with long haul freight, and that in turn is going to have a massive impact on the oil market. This is not immediate, but sometime this decade, the oil market will have what happened to the coal market happen. It'll hit its plateau of demand. And it will start to flatline, it will flatline, and then we'll have decline in our sights. And capital chases growth. And so capital already fleeing that sector is going to flee that sector even more rapidly when we hit the point of oil decline. Now, all of that is a lot of optimism in tech, but let me be clear, despite that incredible pace of innovation, we are not on path to stay below 2 degrees Celsius warming, let alone 1.5. 2021 will be a new record of global emissions. And every year that we set new records means that the eventual slope at which we have to reduce emissions to stay below 2 degrees C or 1.5 degrees C gets sharper and sharper and sharper. And the biggest challenges I see now, even though we've barely made any progress to some extent in electricity and transport, we've made economic progress, leading indicator progress of the tech getting cheaper, but the deployment still is very, very early. But there's other sectors where we haven't even gotten the technology to be cheaper. Ag and land use, cattle and deforestation, 1/4 of all emissions. In industry, industrial processes, making steel, cement, plastics, chemicals, another almost 1/4 of global emissions. Heat, for building heat, mostly natural gas. Ships and planes, not really that big actually. Aircraft about 2.5% emissions now, but rising rapidly. These are the frontiers that I increasingly think about. I think it's now pretty much a done deal that clean options will win in electricity and ground transport. Doesn't mean I don't want to invest in them or that I don't want them to go faster. I do invest in them, I do want them to go faster, but I no longer think of that as an existential threat. 100 years from now, electricity will be clean, ground transport will be electric. But I can't say that for sure yet about how we produce meat or how we produce steel. And so those are the areas that now have more and more of my eye on them. And I will say, I know in Australia, it's not the best time, and it hasn't been the last few years from a politics or policy standpoint, but there is progress being made globally. We still don't know what's going to happen in the US, but even with uncertainty at the federal level, we've seen massive progress at the level of individual US states in the US. And Europe has really been the leader. And Europe setting targets, more and more aggressive targets for 2030 and aiming for complete decarbonization by 2050 is pioneering the technology to do this. And that technology will then ripple out to the rest of the world. And even China and India now saying 2060 and 2070 respectively. Not yet a lot of detail on that or a lot of teeth to those policies. That's unlooked for, but a very big thing in terms of how fast the world will decarbonize. And increasingly, businesses, global brands, B2C brands, really under pressure from their consumers saying, we're going to go clean. They did that in electricity, and you see that happen in more and more sectors outside of electricity as well. And so those factors give me hope and lead me to conclude this is the best time ever to be a climate investor and to be a climate entrepreneur. And so stop there so we have some time for conversation.
Thanks, Ramez. That's great to get through that. Mike, you've unmuted. You got a question for Ramez?
Yes, that's okay. Mike, so I'm interested in your view. Obviously, silicon helped drive down costs of manufacturing solar panels. Is there an equivalent with batteries? One of the problems that we sort of see at the moment is trying to pick a battery company to invest in. How does it get 10 times cheaper? You know, similar raw materials, similar casing, all that sort of stuff. How does that Wright's law price decline happen in batteries? And what do you see as the most interesting technologies in that space?
Yeah, it's a great question. I do think, I mean, lithium-ion batteries have dropped by a factor of 10 in the last decade, as is. So with batteries, there's really two separate markets. One is mobility, and that's the biggest market, the electric vehicle market. And the second is grid energy storage. Grid energy storage is easier, honestly, because you don't care about mass or volume. You just care, is it cheap and does it last a long time? And there we have things like the company I showed, ESS, uses no scarce materials. There's no cobalt, not even any lithium, no nickel, it's just iron and salt. So that allows you to get down to much, much lower costs. And we think they're gonna get down to a $20 a megawatt hour round trip cost for electricity. Now, for electric vehicles, getting down by a factor of 10 is very challenging, but it's not impossible. If you look at the cost of a EV battery today, more than half of it is the raw materials, mostly in the cathode. It depends on which company you look at. A lot of that is cobalt. And then there's other scarce minerals in it. But so you see a huge effort in battery manufacturers in moving away from cobalt. And I can't see how any cobalt-based lithium-ion battery chemistry really is competitive 10 years from now on a cost perspective. And you also see investments in trying to increase the production of other scarce battery minerals, like lithium being number one among them, but also nickel. So another company in our portfolio is Energy X, where you see 3 at least prominent startups working on ways to massively increase lithium production at lower cost to meet the demand for batteries. So can we get down 10x? Maybe eventually. I think we can drop by a cost factor of 3 to 5 over the next decade, between now and 2030. And that's enough to lower the cost of electric vehicles to below the cost of gasoline and diesel vehicles.
Thanks, Ramez. Alex, you're up next. Then I'll go to Bill and Eitan.
Hey, Ramez. It's good to be on a call. Yeah, I cheated earlier with the Germany question because I saw you out here in Sydney for the Singularity event. So it's good to be on a call with you. I'm a founder in the climate space, land use, natural capital. I guess more broadly, though, my question is, now that you've been playing the role as an investor and advisor to startups, interested, your flywheel, to quote it, has policy as part of the flywheel, which can probably send the flywheel flying even more, or sort of like ground to a stop. How do you advise founders on that as part of their flywheel, and what sort of implications do you have as a focus?
Well, it's a great question. I look for sectors where I think there's policy momentum, or either where I think one of two things, either where the technology passes what some people would call the Mr. Burns test. It's a reference to, oh my gosh, the cartoon you all know.
Simpsons, yeah.
Yeah, exactly, The Simpsons. is the technology interesting to somebody who doesn't care about climate at all, or will eventually get there? Or if it's not there yet, is there sort of clear policy momentum around the technology? And so I'd say in clean electricity, there's obvious, clear policy momentum. It's now clear, watching this for 20 years or more, that the world's regulatory policies around what fraction of electricity in a given grid have to come from clean sources are just going to keep ratcheting up and up and up. They're ratcheted up in the EU, they're ratcheted up in US states, they're ratcheting up in China and India. It's just going to happen. Similar thing with EVs, sort of the Norway in the 1980s putting EV mandates, China's putting in EV mandates, the EU is putting in EV mandates, various US states putting in EV mandates. It's obvious that 5 years from now, the policy around electric vehicles is going to be more aggressive than it is today. Another one coming down the pipe, hydrogen. It's clear that the EU is going to keep pushing on hydrogen. Japan is going to probably push on hydrogen. I can't tell you exactly what time frame they're going to get what policies. I can't bet on a specific policy, but I know that 5 years from now, 10 years from now, there's going to be more policy in place, either for decarbonization of industrial segments like steel and cement that might be consumers of hydrogen, or for deploying green hydrogen, period, that are going to put demand on that. So that's how I try to think about it.
Definitely need more policy optimism here in Australia, Ramez, but I think the world pressure, certainly Europe, is making it that Australia can't keep going with that kind of attitude anyway. So, Bill from Minosi.
Yeah, excellent. Very, very good, Mick. Thanks for organising this. On hydrogen, just wanted to follow up on that. When you've got a 5-10 year horizon on hydrogen being more adopted, do you see it coming in for EVs at all, or is that a bit of a not really going to happen?
I'm strongly opinionated. Hydrogen is dead as a doornail for ground transport, except possibly for trains and maybe mining vehicles and forklifts, a few fringe things. But for cars, trucks, and buses, hydrogen is dead, 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 dead.
And why is that? That's a tech thing, or is it more just EVs won the race?
Distribution.
It's a cost thing. If you have a clean electron and you move it through the grid into a battery, and then you put it to electric motors, you get, let's say 80% of that energy. If you have a clean electron and you put it into an electrolyzer to make hydrogen, and then you compress the hydrogen to move it in some distribution network, and then you put the hydrogen into an EV, and then you run the hydrogen through an electrolyzer to make electricity and send it to the motors, you've just lost more than half the energy, maybe 2/3 of it, and increased the cost by a factor of 4. So it's just like, it makes no sense. And I would short Toyota if I was ever somebody who shorted retail stocks. Like, companies that don't get this just confuse me entirely. Electric drivetrains have won for any ground transport that is less than 1,000 kilometers per recharge. Nothing else. Hydrogen is dead as a doornail. But hydrogen has huge potential for decarbonizing steel, for seasonal storage, for high temperature heat applications in industry, for as a feedstock for making fertilizer without having to burn natural gas. It's a feedstock for plastics. There's a lot of applications for hydrogen, and I think it's a gigantic multi-trillion-dollar market there. But if I see somebody that's focused on transport, I'm just like, what are you thinking?
No, and it's good on green too, because they've got to trace that. France made that, a mandate that's got to be traced to clean energy at the time. So that was a good one for us. So we quite like hydrogen. Thanks.
Thanks, Bill. I'm going to quickly throw to Eitan because he's gone mobile, but still got a question. Sorry, Eitan, I muted you. Quick one, Eitan, and then we'll just throw to Tim.
Thanks, Ramez, and thanks for the presentation. So I'm just waiting for an Uber, so I'm just standing outside. I was interested, the flywheel concept, which I'm completely on board of, where you've got policy and investment all kind of, combining together and moving things faster. You just talked about it before in sort of a passive way, that you're looking for areas where the technology exists and where the policy's in place, and that's a great spot to invest. But we can be more intentional about it, obviously, and actually invest in the in the policy and advocacy, if you know what I mean. So my question is, I guess, if you're seeing that as more of a trend, like investors getting involved more in policy and advocacy and actually intentionally trying to get flywheels moving.
Somewhat. So I've been a policy advocate. I've been to DC and lobbied. I've worked on a couple of climate initiatives here in Washington State and the northwest corner of the U.S. and put my own money and my time in that. What I see is most financial investors are a little hesitant to do that because, frankly, financial investors want to get capital from limited partners who may or may not align politically with them. And, at the firm that I'm at, some of our limited partners are probably much more conservative. But if I can put their capital to use funding clean tech, amazing. It's fantastic. Now, I will say what does happen is as the industries grow, those industries get more and more political power. And so, the solar industry and the wind industry and the electric vehicle industry in the US, the EV industry, you can't separate from just the automotive industry at this point. Like all the auto OEMs, Volkswagen, Toyota, have now decided that electric is the way to go forward. And so now, because of that, they're lobbying their lawmakers in national governments to create more incentives and so on for them. So I think that's the path via which a lot of this happens.
Great. Charlotte, I'm just going to throw back to Tim to see if you still got your question.
Hey, Ramez, thanks for that. That was a really interesting presentation. You focused a lot on, I guess, a lot of the exciting stuff happening on the supply side. What excites you in terms of the opportunities that's going to create, I guess, in the demand side and how we consume energy?
I think there are some interesting things on the demand side. I think certainly for electricity, there's opportunities to get to more flexible and dynamic pricing, which allows for smart demand. I tend not to bet on things that require the consumer to make sophisticated demand choices. There are things like that make good sense. But I'm really excited about places where new market rules and the increasing competitiveness or disruptive pricing of clean energy choices mean that smart demand can select for it more. Now, where I do think demand can make a really big difference is in the B2B2C category, more so than B2C, by which I mean, if you look at clean electricity buys around the world that are in some sense B2C, they're primarily corporates. They're tech companies and consumer brands, the REIs of the world, the Nestle's of the world, that want to communicate to their customers that they're clean. And where it's sufficiently cheap or even profitable for them to buy clean energy, that they might as well do it as a way to protect their brand value that is so high. So that's not the only place. There are other interesting demand places. And I should draw a distinction between where is consumer demand for clean big enough to make a big business versus where is it big enough to make a big difference. And there's a lot of places you could make a profitable business that I think are still noise in terms of actual decarbonization. So I'm focused on the latter. Where is the demand equation big enough that it can knock out, half a gigaton of carbon? That's the Breakthrough Energy Ventures rule or something on that scale. And it's really hard to motivate people to change their current consumption patterns unless their suppliers are just offering them an option that says, oh, and this is clean and you love this brand also.
Yeah, good question. Charlotte.
Hi, Ramez. It was so lovely to hear your presentation and your just optimism for the future. I confess I earlier in the day read Michael Molitor's take on COP26, so I was feeling a little down. So thank you for presenting all those opportunities. And this is just semantics, but could you explain, because you're incredibly articulate and know this space so well, the difference between clean tech and climate tech, if there is even a difference?
I really can't explain that. I'll try. Climate tech is a new word being used. If there is a distinction, I'd say here's what's happened. Clean tech had a bubble, in this 2011 wave of bankruptcies of solar and biofuels companies primarily, and then lingering after that, some failures of energy storage companies. And you had, venture funds like Kleiner Perkins or Khosla that suffered massive losses in their investments. So I think the new wave of climate tech is, in a way, a chance to differentiate from that and leave it aside. That's one answer. The answer that's maybe more useful is clean tech used to be all about energy for just two sectors, electricity and transport. And now we do see in the new climate tech wave, people including clean meat, alternative proteins. You see people looking at carbon capture. You see people looking at textiles. You see people looking at a variety of sectors that are not just electricity or road fuels in that category. And that's probably the most charitable definition I can give for climate tech versus clean tech.
Awesome. Joanna.
Hello, good to meet you, Ramez. I guess I'm coming from two sides, is that with the climate tech, clean tech, when it comes to energy efficiencies, that has a really big part to play. And the two-sided is that both in policy, we've already seen a number of countries around the world dip their toes in energy efficiency policies, and that can only grow. And then the other side, the practical side, is that if we can bring in 20% increases in efficiencies, that should reduce our need for developing all this clean generation by 20%. And all of the tech required to build generation requires a fair bit of, extraction. It's going to have its own impact on planet and climate as well in the construction of generations. So I come from a place of focusing on improving the efficiencies, reducing the impact on environment, thus society, thus the economy. So just wondering what your comment is around the efficiency space and the impact that it has.
So I'm a huge fan of efficiencies, and we see it very clearly. If you look at, for instance, US energy use per home or per capita at home, it's flat over the last 50 years, even though per capita living space has tripled in the US over the last 50 years. And that's because of increased efficiencies, better heating and cooling, better insulation, more efficient appliances, and so on. I found it personally hard to invest in efficiency from a venture standpoint. It's something that gets deployed a lot and achieves a lot of savings, but business models in it, I think, have been really challenged. And some of that is organizational misalignment of who's responsible for the costs in an organization versus who has the signing authority. Is energy use considered really a key part of an organization, or is it just delegated to the facilities people who may not have the ability to sign a big deal for energy efficiency play? Those are the struggles that I've seen efficiency companies hit, and finding ways to circumvent that. It's a business model innovation and a sales model innovation as much as anything else that I think is needed to really unlock that.
Thanks, Ramez. Malcolm, squeezing the last question.
Thank you, Mick. Ramez, you talk to a lot of business audiences. Sort of double barrel question. One is, that was incredibly energizing, so I loved it. What's their big aha takeaway when you present? And then retrospectively looking at their action, what is the best actions you're seeing your audiences undertake? Having heard you speak and obviously others, but the penny drop and then action. Love to hear your sort of wrap up thoughts on people listening to you tell this story, because I found it awesome.
Thanks, Malcolm. It's changed over the years. When I started telling the story, it was 2010, and I could draw those curves of here's how solar would be cheaper than coal in some places in 2015, but it hadn't happened yet. So it was harder and harder. It was harder to believe back then. And the story's gotten more believable over the years. So I think that just the numbers of how low the costs are of clean electricity in particular, and by extension, then at number two, sort of what's happening in electric transport, I think are the biggest aha. The single biggest response that I'm happy for is an Asian bank that after the CEO heard me talk said, well, we're just going to stop funding all coal projects because it looks like a terrible investment for us. And so that, probably would have happened 12, 18, 24 months later. I'm a messenger. I'm not the one that's causing these costs to drop, but a lot of large organizations are really bottom line oriented. Most people that are executives at large organizations believe in climate change, believe it's real, would like to be on the right side of it, but don't have a bottom line argument to take to their shareholders, their board, their CEO to make a change. And that's, I think, what's missing in many cases.
Awesome. Great outcome.
Excellent.
More of that, please.
Yeah, definitely. Pavel had a question, but he's going to email it to me and then I can pass it on to you, Ramez. If everyone can just really, really quickly turn on their videos if you're able to. I'm just going to get a quick selfie of everybody here. And you can fix your hair up, everybody. That's great. I'm going to do the cost curve of solar. That's no one's going to ever understand it, but I'm going the wrong way potentially. But ready? 3, 2, 1. I'm going to be using that image as blackmail to all of you over the next 10 years. So Ramez, amazing to share. Thank you so much. We will also find out to try to send you some of our companies so that to invest in some Australian, New Zealand companies. We've got some amazing technology and founders coming through here, as well as co-invest with some of our fantastic investors solving problems across ag, energy, storage, construction, etc. So, but really fantastic to share. And hopefully when we open up a little bit more and get our own flywheels going, we can come and visit maybe in Seattle. Hopefully not when it's at 42 degrees, but yeah, so let's hope that the weather stays very nice. But thanks again so much for sharing, all the members of Climate Salad. Thanks for jumping on board. I really, really appreciate it. And we'll see you all in person soon.
My pleasure.
Excellent.
Thank you all for what you're doing.
Thank you. Thanks, Ramez. Bye.
Yeah.